1986, and it's about investment banks and commercial banks. Now, banks obviously play a very, very important part within the economy. And you can remember in my first lesson of macroeconomics, we were talking about the long diagonal supply curve and how you shifted out investment, technology, education, enterprise, productivity. One of the key things we looked at then was the institutional factors within the UK. And you must have a good banking system, because the banking system takes savings and it turns that into investment. And one of the things I'm going to end up by looking at the end of this little session here is I'm going to look at zombie banks. And if you remember a lesson I did on inflation and deflation, and a lot of people think that deflation in Japan, the reason why Japan had a lost decade was because of deflation. The actual reality is it was partially obviously because of deflation, but perhaps more importantly was the fact that a lot of their banking system was really bust. It had made a lot of dodgy loans. Now, what the Bank of Japan decided to do was to keep those dodgy banks going, call them zombie banks. What happened then was the zombie banks would not use their function by getting rid of the bad firms or the firms that had gone bust. Because if they got rid of the bad firms, then it would have affected how much that bank was actually worth. Now, some commentators think in the UK we have at least 80 billion pounds worth of dodgy loans, and these are on the balance sheets of banks. Some people believe it could be much more than that. Some people believe it could be, say, 200 billion pounds. Now, that will have a big impact in terms of banks have to eventually get rid of those dodgy loans, or they have to wait until they become that much stronger before they start lending money out again. So if you can remember that. Okay, but first of all I'm going to look at is how do banks in fact create credit, and there's a lot of important functions on here. There's the money multiplier and the fractional reserve ratio. The money multiplier says if you put 100 quid in and the money multiplier says equal to 10, then that will turn into £1,000. And the fractional reserve ratio is how much cash the banks have to keep in relation to the deposits that are made. Okay. I've drawn here a little picture of the UK, and I'll pretend that all the UK citizens, for some reason, they all want to move abroad and they want to live in Spain and Greece and Portugal. So we've only got 3 people left: William, Sid and Graham. William comes along, he's got £100, he puts £100 into the bank. The bank keeps 10 quid of that because they know that William will only demand £10 out in cash. This then is lent to Sid. Sid wants to get £90 out of the bank, and he wants to buy Graham's coconuts. So then he gives the money to Graham, and then Graham goes along, and when he gets his 90 quid off Sid, he then puts that £90 back in the bank. The bank only needs to keep £9 of that, so then they lend £81 out again. Now eventually that process happens again and again and again, and eventually we end up in a situation where the £100 is turned into £1,000. How do we get that figure? We get £100, we divide it by the fractional reserve ratio, which is 0.1, 10%, and that turns into 1,000 quid. Okay, so what happens if the fractional reserve ratio is 20%? And therefore it's 0.2, that obviously turns into 500 quid. How do we get that? So William comes along, 600 quid in the bank keeps 20 quid, lends out 80 quid to Sid. Sid goes out and buys Graham's coconuts. If we have coconuts or we grow coconuts in the UK, maybe that's due to global warming or something like that. Graham has 80 quid. Graham then puts the 80 quid in the bank. The bank keeps 16 quid and lends out 64 quid. And eventually that process will go on and on and on, and eventually we'll end up with 500 quid. Okay, outside of all of this, we have the Bank of England. So the Bank of England looks after the whole of the money supply within the UK economy. And the Bank of England can influence the money supply. Now, one way it can influence it quite clearly is if it wants to reduce the money supply, it can increase the fractional reserve ratio, and therefore banks will not be able to lend out as much money. Or it can reduce the reserve ratio. But right at this moment in time, it wants to increase the money supply. So it can increase the money supply by buying bonds from the banks. So the banks will hold government bonds. So the Bank of England says, okay, we'll come and buy your bonds, so therefore the banks get more cash. Or it may actually go and buy the dodgy assets of the banks. So the banks might want to get rid of some really bad loans that it's made. And so the Bank of England says, look, we will give you cash for these loans, so therefore the banks have more cash. And then the idea is that hopefully the banks will then lend that money out to the public, to businesses, and hence the money supply will increase. Or if it wants to reduce the money supply, it can sell bonds, and when it sells bonds, it will suck up all that cash, and the Bank of England will hold that cash, and then hence that will have a sort of money multiplier effect, work in reverse, and that will go and reduce the money supply. So this is how do banks create credit, fractional reserve ratio, the money multiplier, how the Bank of England can influence the money supply, and the real problem, which I'm going to talk about later, is the role of zombie banks, particularly in Japan, where they had a lost decade. Okay, this is lesson 86, and I'm just going to talk about commercial banks. So the end of this session, you should have a sort of a slight appreciation of what commercial banks do and why they are less risky than investment banks. However, there is still a lot of risk even involved with commercial banks, and one of the big ideas from the government at this moment in time is to have a split between them, which they did before 1999, where you had a retail bank, which is just a retail bank or a commercial bank, and an investment bank. Now what's happened since 1999 is that those two have joined together. So Barclays and HSBC, they are a retail bank or a commercial bank, but also an investment bank as well. Now some people believe those should be ring-fenced. And what I'm going to say is that, okay, commercial banks are less risky, but they still get involved in risky deals. All right. So here we have a commercial bank, and it's known as the retail banking arm. What it tends to do is it brings in savings from people. So people put money in the bank, they get a fairly low rate of interest back, and then with this money they make loans. In particular, if they're a building society, then they tended to make loans to people who wanted to buy a house. But if they are more of a commercial bank, they will also lend and give money to other companies. So they play a very important role in terms of the country at large. Another thing they also like to do, which is a very lucrative thing, is to give out credit cards. So if they're paying 3% on their savings, but they are making 20% on the credit cards, then suddenly these banks are making a lot of money. Okay, so where do these banks initially get their money from? Well, they get their money from shares and past profits. And we can say that those are the bank's own funds. So they've been lent the money through shares. So those people who've bought the shares in those companies are then taking a risk with that bank, but then they have those funds. And then with some of those funds, they will lend that money out. Now, one of the things with banks is that the government will give them a minimum capital requirement, even if you're a commercial bank. Now, I think at this moment in time, it's about 7%. But let's pretend that banks have a minimum capital requirement of 10%. Now, what we need to do is to weight that risk. So they do it on this particular formula here. So they get their own funds, which in this case, I've just said is £100 million. And then they get risks weighted assets on there. And how do they perform that calculation? And I made a very, very simple one over here. So let's say this particular bank lends out £200 million in terms of mortgages. Now, mortgages are very low risk. Now, in particular, let's say this bank is really, really low risk, because it says to anybody who wants to take out a mortgage with them, well, we want a 50% deposit on that money, on that house. So if you buy a house for £200,000, you've got to put down a £100,000 deposit. Therefore, it's extremely low risk, and the bank's not going to lose their money because they have the house in terms of collateral. They own the house until the mortgage is paid off. So they've lent out 200 million quid, but I'd say this is low risk at 0%. So therefore, it comes in at £0. They also lend money out to corporate loans, big companies, and they've lent out £400 million here, and they say that these are riskier. We're going to give them a risk weighting of 50%. So 50% of 400 million is 200 million. And they followed the government's advice. They're desperately keen to get on the side of the government. So they've lent out loads and loads of money for new startups. New startups are very, very risky. So they give them a weighting of 100%. And they've lent out 600 million quid. And 100% of 600 million is still 600 million quid. So the risks weighted assets come to 800 million quid. Now, here, the firm has 100 million pounds, okay, of its own money. Divide that by the risk weighted assets, which is 800 million pounds. And we divide that, and out comes 12.5%. This bank has met its minimum capital requirements because the Bank of England says they only need to have a 10% weighting on here. So this is about commercial banks. Commercial banks are the less sexy, is the word they often use, part of banking. And what's recently happened is they've merged those two sectors together, like Barclays and HSBC. So they've got commercial banks and investment banks all in one. Investment banks inherently make more risky investments. Okay, so this is lesson 86, and we're looking here at investment banks. Now, investment banks are the slightly more riskier, more aggressive sector of the banking system, and you know, our image is that they're all made up of lots of alpha males who go around making big deals. They also attract very, very clever people, and they tend to recruit from the best universities simply because that is like a selection process, because the brightest people are probably going to be the ones who make the better investors. However, that needn't be the case. If you go out there and you create your own reputation and you're streetwise, then there's no reason why an investment bank wouldn't want you, because you're certainly capable of also making a lot of money. So they may well, don't always think you have to go to the best universities to end up at the best firms. That may not always be the case. Now, Goldman Sachs and JP Morgan is just an investment bank. So they put their shares on the stock market, they raise money, and then they go and invest that money. So how do they make their money? Well, they have a lot of things called prop trading, and just very, very quickly, they will go out and they will buy and sell currencies. They will put money into new firms. They will spend a lot of time going around the world seeing which firms make money, where they can make the latest deals. Where people are slightly anti is they will speculate in terms of commodities. So they may buy up commodities which are in short supply. A lot of people are saying that they may be buying up loads and loads of food, and then the food price shoots up, and therefore people can't afford to buy the food, so therefore they go hungry, right? That's where investment banking often gets a bit of a bad name. Gambling, there's nothing wrong with that. I mean, these people are using someone else's money, but those people who put their money in know that they're taking a risk with their money and that they could also lose money. So they work on their track record. Where I would slightly, a bit more than slightly, where I'd be anti-Goldman Sachs is where they were involved in the bond issue with the Greek government. So they looked at the Greeks' balance sheet. They knew it was a bit dodgy, but somehow he got a AAA rating. They then went to Deutsche Bank and says, look, you can buy these Greek bonds, they're really good. You get a slightly higher rate of return than you would do with UK bonds or with German bonds. You go out there and buy them. And then the Deutsche Bank went and brought these bonds, and then hey presto, Goldman Sachs knew that the Greek economy was in a really bad way, and then the bonds fell down in price. Therefore Deutsche Bank lost a lot of money. Goldman Sachs made a lot of money because they then bet that the Greek economy was going to suffer and that those bonds were going to go down in price. They knew too much. They were involved in too much of the trade situation. And in no way should they have audited the Greek economy accounts and said that the Greek economy was very stable, because it wasn't. Okay? They also deal in mergers and acquisitions, and then they will get a fee for that. And they will advise people on whether or not it's buying another company and how they're going to merge together. They'll also involved in flotations, and then they will take a certain percentage of that money. But what they will also do is they will underwrite the share issue. So let's just say that they're trying to sell a company at £5 a share, but they may underwrite it and say, well, if you only get £3, then we will buy up all your shares. So you will definitely get the money. But because of that, they're taking big risk. Therefore, they want a large commission of that. They also deal in things called structured investments, which is another complete story, and those products tend to be quite complex, and I'm not willing to go into it now. But let's face it, right? Investment banks do what they do. They make investments. A lot of it is involved around gambling. It's like working at a casino, but these are very intelligent people making very intelligent decisions. And if they don't make money, right, they're not gonna get any shares. They're not going to people will not buy the shares in that particular company. Okay, so that's Goldman Sachs. That's an investment bank. Barclays and HSBC do both. They have an investment bank and they have a retail bank. Now, the reason why they get a bad name is because they may be using money from the retail bank and using it to fund the investment bank, and then putting those funds at risk. And this is when banks become too big to fail, because if they do go under, then they'll bring down the whole economy. Right, the retail banking sector, which I've just been through, is like the bread and butter part of the banking system. Although, as I've said in my previous video, they're still making some pretty risky investments. They're still wanting to invest in new companies. They invest in mortgages, which is meant to be low risk. But if there is a housing market crash, then these companies can also be stung in terms of that. They're also making loans out to big corporate firms. But there's a big argument at the moment that these two areas should be split up. One of the problems, though, with doing this is the retail banking sector or the commercial banking sector is still risky. But it's probably less risky than this branch here. Or let's say if this company goes bust, if Goldman Sachs goes bust, everyone just loses all the money. They lose their money in terms of the shares that they put into that company. Now, I think that seems to be perfectly fair, but maybe the government will just back these companies. However, in terms of if they go bust, then they will not let them actually go bust. But in terms of doing that, then they need to regulate these to maybe check that they have a much higher fractional reserve ratio or something like that. So we've got the idea of commercial banks and investment banks. Lesson 86, and we're still on the commercial banks and investment banks, but now we're going to look at the structure of a bank's balance sheet as well as the conflict between profitability and liquidity. Okay, so the structure of a bank's balance sheet is anything that the bank will owe. So for instance, when they have shares, then they will owe money to their shareholders, so therefore it's a liability. If someone comes in and gives a deposit, either as a savings deposit or a current account deposit, then the bank will owe them money. Or if they borrowed money themselves, then that is all a liabilities. Remember this bit down here when we were doing the zombie banks? Well, this is when if a bank's liabilities are greater than its assets, then therefore you become a zombie bank. The assets of a bank is all the money that they've loaned out. So for instance, if they loan out money so someone can buy a house, remember the bank still owes that house until the complete mortgage has been paid off. However, if the house falls in value and they've lent out 200,000 quid and the house is now only worth 50,000 quid, then it's the bank who's going to take the hit, because the person who's bought the house can walk away and say, well, the house is yours, I'm not paying you any more money back, and therefore the bank has just lost the money that it's lent out in the first place, because they can't sell their house for more than £50,000. But if a bank happens to make a lot of bad loans, right, then you'll end up in a situation of where the bank's liabilities are greater than its assets, and that's when you become a zombie bank. Now, normally what happens is, in the free market system, if that is the case, then you go under. You're out of business. That happens to any business. However, in this case, because the government will want banks to continue, because they may bring down lots of other firms with it, and all the people who have their deposits in here will be very, very upset if they go bust. then they protect the banks. Okay, so right now we have very low rates of interest, which will help the banks because they can borrow money very, very cheaply, and then they can lend it out more expensively. So eventually that will improve their situation. Also, as house prices go up, that will help them in terms of the amount of money that they borrowed. And the Bank of England has also brought up a lot of dodgy assets of the banks. So they said, give us your dodgy assets, we'll look after them, and in return you'll get cash for them. So therefore that obviously makes the bank stronger. Now, there's another conflict always between banks, as with any business, between liquidity and profitability. Liquidity because customers always want cash, and shareholders always want dividends, so they want to make money out of the shares that they've invested into that business. And as we go down here, there's going to be greater profitability if you give out loans and overdrafts, but there's going to be less liquidity for the bank. So this is a very liquid situation, but the banks only keep a small percentage of cash, about 7% at this moment in time. This is less liquid, but this is the way in which the banks can make most amount of money when they give out loans and overdrafts. Now, but banks aim to manage that risk. So obviously by buying government bonds, they are not as risky as giving out loans. Okay? So there is a conflict between liquidity and profitability in the banking sector.